Unemployment is peaking at 4.2% in the first half of 24, and it's going to go up from 3.9% from now. So unfortunately, for the feds to hit that target rate of 2%, 3/10 of the population is going to have to be unemployed, which seems counterproductive, but that's what they got to do to get inflation under control. Let's talk about the state of the market. Now, you all know the quote here on the left. This is coming from, this is The Office, right? So you see him saying, I can raise and lower rates at will. And she says, why would you want to raise interest rates? And he says, so I can lower them. And that pretty much sums up the Federal Reserve, doesn't it? Why are they lowering rates? Why are they raising rates? Why are they pausing on rates? It's all tied to inflation. So when you guys understand, they're trying to get that inflation down to that goal number of 2%. That's the goal. And they're not there yet, guys. In fact, if you look at the inflation index, which is right here, okay, the inflation index right now is sitting at 4% right now in the month of December, and it's falling below 3% by spring. So when they raise rates, typically they see a large layoff. Big employers will lay people off, so we have higher unemployment. Higher unemployment leads to less consumer spending. Less consumer spending drops demand, which reduces inflation. But with that, unemployment is peaking at 4.2% in the first half of 24, and it's going to go up from 3.9% from now. So unfortunately, for the feds to hit that target rate of 2%, 3/10 of the population is going to have to be unemployed, which seems counterproductive, but that's what they got to do to get inflation under control. So let's look at the year in review, all right? In September, or as of September of 23, the average median home price across the country, now this is not territory specific, this is an average across the nation. This is coming from the National Association of Realtors. The average median home price up 2.8%. The nation had a 3.4 month supply of housing inventory as of September per NAR, which is low enough to be considered a seller's market. Now remember, you guys, the baseline of what is considered a healthy real estate market is a 6-month supply of inventory. So the fact that we're still sitting on 3.4 months of supply means we're still at about half of the normal supply that we should be seeing. Because of that, if a property is priced correctly, it will sell in this market even though rates are inflated. Now, last month when we were doing our CEO Fireside Chat, we were seeing rates at 8.25% for conventional loans. And as of today, an FHA loan is sitting at 6%. So rates have come down considerably, which is going to gobble up that available inventory. So that could be going down. So we're not necessarily in a buyer's market where you can just go out and demand a price from a seller and all these seller concessions. Now, there are certain price point levels. And I will tell you this, you guys, everything I'm talking about right now is specifically to properties below the FHA cap. So if you don't know where the FHA cap is in your market, you can go to cococapital.com, scroll to the bottom of the page, type in your state, your county. It'll tell you exactly what your FHA cap is in your market. But if you are looking for properties above the FHA cap, in that $600 to $1.2 million range, depending on where you live in the country, this is where you're going to see the greatest reductions of price. The greatest seller concessions are occurring in that price point because now you're dealing with a higher end, typically a buyer whose income annually exceeds $100,000 a year. There is far more room to negotiate at that price point level than below the FHA cap. So just be aware of that, all right? As of August 2023, home price growth rose by 2.6%, marking the 7th consecutive month of increases. And this occurs according to the S&P CoreLogic's latest Case-Shiller Index. Bankrate's latest national survey of large lenders shows the average rate on a 30-year mortgage was 7.69% as of November 8th. Now, what I just gave you is hot off the press. These rates just came out this morning. So you can see that just as of, 26 days ago, That was a 30-year mortgage. Right now we're sitting, that's conventional, at 7.69. Right now we're sitting at 6.99 on that same conventional mortgage. So it has dropped 70 bips, which is pretty significant over just the last 26 days. The U.S. inflation rate as of October 2023 was 3.2%, still a bit higher than the Fed's stated goal of 2%, as we talked about.